Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me well? All right, so we are going to discuss the mock exam of AA, which has been published by ACCA. And it is wonderful, actually. The mock is wonderful. So let us proceed. Let me open that with you people. So I am opening the ACCA practice platform where this mock is pre-December 2025 mock. So let us start with it. Yes, starting with the first question. This is the OTQ we are going to solve now. And OTQ is about which two of the following initial actions should Red Bridge and Company take following Northgate Company's refusal to allow Rebridge and Company to seek a bank confirmation from Siddique Bank. Now, understanding the question is the first thing. Normally, the blunders which is done by the student in OTQs, that students are in a hurry to complete and answer the question. So they say that, okay, so we will be here. Here is the information. It is 1st July 20x5. You are audit supervisor of Red Bridge and Company, working on the audit of a listed company, Northgate Company, for the year ended 31st May 20x5. The area of bank and cash has been assessed as high risk due to a large number of transactions near the year end. Northgate has various long-standing accounts with three banking institutions. During the year, a new account has been opened with a new institution, Cedar Bank. The management of Northgate has refused to grant Red Bridge and Company permission to obtain a bank confirmation letter from said bank. You have asked for an explanation but have not received a satisfactory response. Being means that Red Bridge Company, they are auditors, and they have asked the client, Northgate, that we want to contact and write confirmation letter to Cedar Bank. This should be very much clear. Okay. We want to contact with them. So you allow us. So if they do not allow, then they are not allowing them. The point is here. So which two of the following initial action should auditor take when they disallow to seek bank confirmation? Very important. Now read the question. Reading and understanding the question is very much important. Now read the 4 points. Yes. If you have not understood the question, I can re-explain it to you people. If you have not understood the question, I can re-explain it to you. Because understanding is very much important. Now, the point, yes, that just see here. Just see here. This is auditor. An auditor's name is Redbridge Company. Then there is Northgate Company. They are client. They have account with the bank. The name is Cedar Bank. So now auditor wants to write a letter to them, confirmation letter. So they have stopped. They don't write letter to their bank. They're not allowing them. So they cannot write a letter to them. So what steps they should take now? What steps? No, without the confirmation request, without the management permission, this letter cannot be written. Wrong. Wrong. Re-evaluate the risk of material misstatement. Yes, because management is restricting our access to contact their bank. So it means we need to re-evaluate. We need to re-evaluate their integrity and hence risk of material misstatement as well. Hence risk of material misstatement as well. Now, so this is the point. Next, revise the audit plan and consider. Yes. No, disclaimer cannot be issued at this stage yet. This is just audit is in process. We have alternate procedure. Some student may say this is scope limitation, so issue disclaimer. No, we cannot do. It will be too early to conclude this. So these two are the points. Okay, next. Which of the following procedure should be performed to confirm the loan liability balance at the year end? Loan liability. Northgate has secured external finance for the first time during the year. The draft financial statements show non-current balance liability in which to loan finance of 1.2 million. So which of the following, not two, means maybe one or two or three or maybe all four, to confirm loan liability at year end? Okay. Which one? So review board minutes for the evidence. Approval doesn't mean that loan has been obtained. Approvals of various loans may have been done. But they say confirm liability at year end. They may have approved a loan, may have received, may have returned, and liability may not be there. So that's why this doesn't make sense. Agree the loan payment recorded in the general ledger to the bank statement to confirm capital has been repaid. Okay. Now, you know that post year end, if some amount has been repaid post year end, it means this loan which was recorded in the year end, which has been repaid. Okay. So it means it is confirming liability at year end. Okay. Now, this is confirming. It was liability at year end. That's why it was paid in the bank later on. Remember that. So basically, they are this is the procedure for existence. Agree the year-end loan liability balance to the bank. Yes, bank has confirmed this is to be paid by your company. Confirmation letter. So it exists at year-end. This does not confirm. This does not confirm. Yes, this can be used to discuss to confirm completeness of liabilities, accurate, valuation of liabilities, because this is analytical procedure. But what is liability at year end? These are verifying these two procedures, 2 and 3. Is that clear? You can ask question if there is any confusion. This is verifying completeness and valuation. This is verifying. This is not verifying amount existing at year end. I hope it is clear. Now, which of the following audit procedure provide evidence regarding the accuracy, valuation, and allocation of share? So this is about amounts of share capital presented in the North Gate and financial statement for the year ended 31st May 20x5. Share capital, North Gate plan to expand its operation next year, and right issue they have done in the current year to fund the new venture. To fund the new venture. Now, so valuation, accuracy. Review board's minutes of the meeting to identify matters relating to, again, this is not about the valuation and amount. It is about the authority and approvals. It has nothing to do with that. Remember that. Because accuracy is about amounts. Amounts recorded. Agree the number of authorized shares disclosed. Authorized share capital is not to be verified here. Authorized share capital is not to be verified here. Here, what has been issued, that is important. Accuracy. Authorized share capital is in the constitution document. It has nothing to be done what is issued actually. Wrong. Yes. Agree closing share capital balance in the trial balance. Closing balance of share capital in the trial balance to the statutory record. What is issued? And financial, now, yes, it is verifying the accuracy, amount. Inspect bank ledger to confirm cash received from the right issue. Have been complete? Yes. What is recorded? 3 and 4. 3 and 4. Now, the next point is wages and salaries have been identified as high risk because it has frequent manual adjustment and complex calculation related to bonuses and holiday pay accruals. Which of the following are substantive analytical procedure for wages and salaries? Analytical procedures. It is not difficult to write analytical procedures. Analytical procedures are comparisons, and proof in total. Again, that is comparison. So the recalculation is not an analytical procedure. Yes, compare the current year total to the last year. No, this is called some verification from accounting record. Now you can say that it can be the tracing. It is not analytical procedure. Yes, this is an analytical procedure. Proof in total calculation. What is proof in total? Do you know? How many of you know what is proof in total? You want me to explain? Tell me. What is proof in total? Proof in total is that, for example, the company 2025 audit we are doing, 2024, there were 1,000 employees of number of employees of company. And average salary was of each employee was, for example, 45,000 rupees. Okay. We say, okay, how many people joined? New joined this year, during the year, 50 new joined, 40 left. So total employees are now 1,010 total employees in 2025. Salary was increased by 10% this year. Inflation rate, for example, it is 49,500 average salary. Multiply. This is the answer, for example. There is adjustment for joiners and leavers. Simplified way, this is called, now this is calculation. Now, what is cost recorded in financial statements? What financial statements are showing and what I have calculated with the average adjustment. Some more adjustments are also done in it. I have simplified it for you to be quick. So, what is the difference? Okay, now. So, this is called proof in total. Let us proceed further. The next point. Which of the following procedures would not test for the understatement of bonus accruals in Northgate Company's statement of financial position? Would not test. Yes, understatement. Reading the scenario, question, and the keywords would not test for understatement of bonus accruals. Now, agree the payment of bonus from post year end to the accrual listing. It is testing. What is being paid, it is recorded or not. It is testing understatement. Agree the bonus from payroll record to, again, it is testing. Payroll record, what is bonus recorded over there and what is in the accrual listing. Compare the accrual to the budget. It is testing. What is understatement? Understatement is basically test for when we say that thing should not be understated. Actually, we are testing the completeness assertion. In other words, okay, now, so this is would not. So it is testing. So it is not the answer. Select a sample of employee from bonus stream. Yes, it is not testing accrual. It is testing only accuracy of amount. These three are testing the bonus accruals. This alone is not testing. Done. Next question is here. Which two of the following corporate governance should ACME should comply with? Let us read it. You are an audit manager at Bureau Company and tasked with reviewing ethical and professional issues that have arisen at various audit clients. Bureau and Company has audited ACME Company for the 7 years. The board has decided that 7 years. It will be listed on stocks in the next 4 years. And has asked Bureau and Company to how to achieve compliance with corporate governance principle. The board is now considering establishing an audit function and has suggested that they may wish to outsource. Now, it means the question is generic. It has nothing to do with this scenario. The question has nothing to do with scenario. The remuneration committee should be composed of independent NEDs. Yes. Remuneration committee must include all independent non-executive directors. That's the principle. Now, these need to be memorized. Some students say, Mr. Hamzah, what is the logic? Man, these are corporate governance best practices. We can talk about the logic as well. But that logic you do not need right now. It should be on your tips. That what is the rule? That should be on your tips. Now, the chief executive officer should be responsible for leadership of board. No, wrong. That is the chairman. Chairman is responsible. The non-executive directors should provide constructive challenge. Very important. Their role is to challenge the executive directors, to review their work, to provide monitoring. That's the point. Audit committee does not approve and appoint. They just suggest, they just nominate. This is the shareholders of company who actually approve the external auditor. Okay, not the audit committee. Now, the next is they want them. Okay, which of the following factors must be considered before Bureau and Company can accept ACME company's internal audit engagement? Okay, which factors? Whether external audit, no. Team. So external team is not needed over there. The separate team is needed. External audit team is not needed. Bureau Company, okay, They want to outsource to bureau company. So that is separate team. If the assignment will relate to internal, yeah, because now listen, very important to learn that. Just see here. So basically, bureau company is auditor currently of Acme company. And so if they are outsourcing their internal audit to them, if they're doing that, so their external audit team will not perform this work. Some other team. So that's why the first point is irrelevant. The second point is, yes, even some separate team is going to perform this work, internal audit over there. Their own team is doing external audit of financial statement as well. It will create self-review threat. So that need to be considered. If they are providing controls related to financial reporting. And very important, this is basically from the topic. This is from the topic reliance on the work of internal audit. Okay. Yes. Sorry. Not that. So if management will accept responsibility, if management will accept the responsibility, means we are providing the service, but we are recommending internal audit recommendation. We are doing them regarding control, regarding other items. Who will be responsible? This is called assuming management responsibility, if you remember, from the ethics chapter. So this responsibility, assuming management responsibility, this should be transferred to management whenever external auditor is providing some additional service to client. Remember, this management responsibility should be transferred. Management must acknowledge it is their responsibility. We are doing this service. Now, so that's why 2 and 3 is the answer. Why not first one? And this is actually creating a confusion. Even for me, for some part of seconds, it created confusion for me as well. Then I saw, oh, really? External audit team themselves will not go for that. Okay, so this is the point. Minor thing. Now, which of the following would result in bureau and company assuming a management responsibility in relation to internal audit service? Now, which one will be assuming a management responsibility? Very easy. Taking responsibility for exactly. If we are providing them this service and we are taking the responsibility, it is responsibility of management. Even we are providing this service. Determining whether the work of internal, no. Remember, this is how smartly examiner has played with you. This matter is regarding external audit team. It has nothing to do with management responsibility because external audit team will come, will review the work of internal audit and check whether their work can be relied upon. It has nothing to do with management responsibility. Something quite unrelated to it, but smartly inserted here by the examiner to confuse you. Setting the scope. Yes, if we are providing internal audit service, we are deciding what work we need to perform. Management is not deciding, so it will be blunder. 1 and 3 is the answer. Next. Which of the following is an adequate safeguard against the threat created by the fee from Webbit company? Adequate safeguard. against the threat created by fee from Webbit company. Okay, we see Webbit company is a listed company. It is a listed company. Okay. Burrow and Company has identified the fee for Webbit and as a result will represent 16% of Burrow and Company's total fee income this year, compared with 15.5% in the last year. So it is has become, we know that code says if consecutive 2 year for listed company, the fee derived is crossing the threshold of 15%. It is self-interest threat. The engagement partner have asked you to consider the safeguards. So 15% threshold for consecutive 2 years, it has crossed. Now, what is adequate safeguards? Disclose to ethics partner. A pre-issuance review equivalent to engagement quality review. This is the point. Students, pre-issuance, this is specific. This is, there are certain threats which is given by the code in the notes, even my notes, retail notes. Specific safeguards are there. Just like this one, pre-issuance review should be conducted. Post-issuance review is done where fee is not that much threat. Not by the engagement partner, even by some independent person. Pre-issuance review should be done. What is pre-issuance review? And what is post-issuance review? Let me quickly. So pre-issuance review, this is the date of audit report issued. This is date audit report prepared, report finalized. Pre-issuance review is done here. That we call, report is finalized, we call some other partner, come review our work, identify mistakes, any problems, in our conclusions, in our evidence. Tell us, we will make up those deficiencies and fix ourselves. And then, if needed, audit report may be modified and issued. What is post-issuance review? Audit report is issued, and after that, we call someone to conduct review of our work, document our deficiencies so that we can avoid in the future. So this is not that much effective. And again, these reviews should be done by some third party, not by engagement partner. In this question, in the D part, may have been correct if it is done by some other partner. But this is a listed company. Risk is high for the and importance is high. So pre-issuance review is more preferable. Now, next. Come here. Identify by clicking the relevant boxes in the table whether each of the following statement regarding the provision of assistance to Elmer company is true or false. Yes. Which one is true and false? Provision of assistance. Okay, what is it? Elmer company, listed company, the national distributor of cleaning products. The management, again listed company, is planning to develop a website for online sales to its customers. Elmer Finance Sector has asked Burrow can provide assistance with the design and implementation of a website and online sales system. Now, student, before I proceed, that this is, they are going to design a system which for the company, which is listed company, client, which will be recording sales. First of all, control system, They'll be designing. It will be assuming management responsibility. Second, there will be recording sales, affecting financial statements, and it will bring self-review threat as well. That's clear. Now, so for a listed company, code says that such a service cannot be provided. Remember that rule is that, note down this rule, that for a listed client, all those services affecting financial statement and accounts preparation, this can't be provided. Simple as that. Because public interest is involved. An auditor must have to be independent. Auditor must have to be independent to be able to provide that service effectively. Okay, now, so a familiarity threat arises at new system in no. What is familiarity threat? Where people know each other socially. Wrong. There is risk that yes, management decisions, management responsibility, assuming that there'll be heightened self-review threat due to an auditor's reliance on controls, testing, and yes, auditor will be relying on this work. System designed may not be testing properly. Borrow company can use a separate team in order to conduct work. No, because this is a listed company, this service cannot be provided, which is affecting accounts and financial statements. Simple is that. Next question is here, OTQ. So ISA 560 subsequent event ISA 560 subsequent events require the auditor should perform audit procedures to identify subsequent events. The period covered by this review for marine company commenced on 1st April 2025. Which of the following dates in the end of the period covered by the subsequent event review? Okay, read it again. So remember, they say that which of the following date is the end of period covered by subsequent event review. Now, very interesting point. Before we solve it, we must know that when auditor need to perform subsequent event review, this again, once again, timeline is here. This is financial year end. This is date financial statement prepared. Audit report signed and issued. And AGM financial statements are approved. Now, the point is, students, auditor has active responsibility for this period to perform audit procedures. Means to do subsequent event review for those events occurring during this period of time. Active responsibility of auditor to review events. After that, only those which come to the knowledge of auditor, only those are checked. Auditor is not doing anything after that. Okay? Now, so the date work will be field will be completed. The date audit report will be sent at that date. Simple is that. Next. Indicate by clicking on the relevant box in the table below whether event 1 or 2 will be classified as adjusting or non-adjusting. Which one? Okay. Event 1. Come here. And what are the adjusting event and what are the non-adjusting event? Tell me before we proceed. Adjusting events are those adjusting events. So adjusting events for which condition of occurrence arise at or before year end. Condition of occurrence. Some they have established they are going to occur. And non-adjusting condition of occurrence arise. They arise after year end, not at year end. So come here. So which one is adjusting? So they say that event occurred on 10th April. Year end is 31st March. Okay, it occurred 10 days after. Okay, whether we need to read the scenario and assess whether any condition of occurrence existed at year end. Now, so the spring is a new type of matter that has been found to be defective. Found to be defective. There has been no sale. It was due to market rate. The company's insurer estimate the inventory to be value of this. Insurer also estimate the matters are now worth only this. No claim has been made against supplier as company is also liquidation with no prospect of amount being paid to third parties. The insurer will not pay for the fall in value and it was underinsured. All inventory was in the finished goods at the end of year and no movement. It means it was only discovered. This has already occurred, so it is adjusting event. Okay, only discovered. It has occurred already. Production of factory was halted for 1 day on 5th June. 5th June event occurred. Okay. Truck, carrying dye used in coloring on fabric on mattresses reversed into a metal pylon, puncturing the vehicle, allowing dye. It is an accident. It has nothing to do at year end. All of a sudden, non-adjusting. Simple as that. Sorry. Indicate by clicking on the relevant boxes. No, which one? This one, previous one, this one? Why it is adjusting? This one? Even one you are asking, Samuel? Your question is about it. The point is, this is adjusting event. Why? Because inventory was in stock at store at year end. At year end. It was just discovered after year end on 10th. So condition of this was just discovered. Condition of occurrence existed at year end. Adjusting event. Is that clear? Is that clear? Okay, welcome. Next. Identify by clicking on the relevant boxes in the table below whether each of the following audit procedures are valid or not valid in relation to event 1. In relation to event 1. Okay. Obtain confirmation from the insurers. The insurer is saying that, okay, will not pay for the fallen value. Amount recoverable under policy. Of course, auditor need to verify whether it is recoverable or not. Valid procedure. Inspect correspondence with supplier concerned. Yes, whether the amount is receivable or not. They are solvent. They say they are not solvent. So we need to check company's correspondence with them. What is the condition? Recalculate the NRV. Yes, auditor will do that. Verify closing value. Now, review post-year end physical inventory count of mattress. It has nothing to do this event. Inspect subsequent event. No, it has nothing to do with this event to verify this event. Post-year defective sale. Why it is not selecting it? Okay, not valid as well. Yes, if we are verifying, applying procedures on valuation of inventory, then this would have been valid procedure. But here we are applying procedures on event 1, only this event to verify. So it has nothing to do with it. Next. Which of the following procedures should be carried out on event 2? Right. Inquire of the director whether they will recognize the provision for a fine. There is no provision. They are just investigating. They're considering it. Why to record a fine? Wrong procedure. Exactly. What is the extent of damage? Auditor will check that. Inspect the environmental agency and any report from environmental agency to determine the extent of damage. That's correct. These two are the procedures to be carried out on event 2. The first, why not first one? Because we don't know whether they have actually breached the law or not. They are still, investigation has not started. They are just considering environmental agency. So why we are checking the fine to be recorded? Wrong. So the 2 and 3 are the correct answers. Next. Now, the following audit procedures should not be performed in respect of this fine. Okay, the audit report was signed at the planned date and an unmodified opinion was issued. It is now 20th July. The AGM is to take place on 21st August. The environmental agency has issued a report stating that they are in breach of environmental law, and a fine of 900,000 will be levied on the company. The amount is material to financial statements. Student, before I go to the question, try to understand. This was a non-adjusting event, so it must not be recorded in financial statements, first of all. Yes. So the fine should be disclosed in the notes to financial statements. Okay. That's it. Nothing else. If okay, because non-adjusting, okay, audit report has been issued. Just a minute, please. Right. Unmodified opinion. That's it. Should not so discuss the matter with the director to determine their course of action. Yes. Ask them. We determine, but it need not to be amended. We know that. If directors amend the disclosures, auditor has not to amend audit report. Not at all. Managed director should disclose it. Director should disclose it. Provide this disclosure ideally. Emphasis of matter paragraph. This is not such a matter of fundamental nature. Okay. Now, if the director decide not to amend, speak at AGM, yes, auditor can inform. No worries at all. So not because this is a matter which is non-adjusting matter. Non-adjusting. Now, next. So section A is done. So let us take a short break. And I want to do from section B as well some questions. So section B as well. Tell me, should I do audit risk or controls or substantives? You just need to send me text here, your opinion. I will take a short break. Send your opinion here, WhatsApp. Which one I should do? Okay, be quick. So I will take a 5-7 minute break. Then I'll be back and continue. Send me text on WhatsApp. Yes, please, everyone now. So let us do section B. In the section B, basically majority students have requested two areas, audit risk and substantive test. So I'll be trying to do the both one. Okay? So the both. Don't you worry. So I'll try my best. So here is the question on the substantive test first. Describe the procedures the auditor should perform to obtain sufficient appropriate audit evidence. To obtain sufficient appropriate audit evidence regarding the existence and valuation of Walker Company's trade receivable. So two assertions are there: existence assertion and valuation assertion. Audit procedures regarding trade receivables. So, what are the procedures regarding existence and valuation? Now, so very easy to learn and to recall. First of all, we should know what are the assertions, what are the procedure for these two assertions, and then drafting. The two steps are there basically. So, Walker Company's draft financial statement at 31st May 2025 show an increase in trade receivables and decrease in allowance for receivables compared to previous year. Okay. Next. To the next is, as a result of lack of responses in the prior year, they have decided that a trade receivable circulation will not be performed. So this procedure has not to be written. Instead, she has asked you to identify alternative procedure. Very easy. If I ask you that what are the procedures for existence, right? For existence assertion. So existence assertion can be verified by one procedure. They have said confirmation letter has not to be done written. Okay, we will not be doing that. Then, then it can be verified by review of correspondence of company with its receivables. With its receivables. Then, then there is a vouching test. What is vouching test? If you have gone through my regular lecture on tracing and vouching, it is explained over there. Vouching test starts from accounts, receivable account, verified through sales account, day book, good dispatch note, and sale invoice. We are why okay, so that is vouching. Then existence is verified through review post year end bank statement. For what purpose? Payment from receivables, which may representing balance at year end. So you see here, how many procedures? One, two, and three. Very easy. And now we have not to only, and yes, any discussion with management or company's record of legal cases regarding any disputed balance, receivable balance. So these four procedures I have told you on existence. So this actually tells whether the balance exists or not. Now, about valuation. Valuation receivables. So you can write analytical procedures that compare this year receivable days with the last year. Okay? And if there is any significant difference, investigate. Then you can write on the allowance for receivable. You can check aged receivable ledger. Again, directly affecting the valuation. You can review board minutes. For what purpose? For what purpose? To identify any concern, any balances which may not be receivable. And they say that the balance, there is decreased allowance for receivable. What we will be doing? We will be talking to finance director, directly affecting valuation. Inquire finance director. The reason for decrease in allowance for receivables and assess the validity of response. That's it. Next. So you see here, 6 marks, but I have given you 8 procedures easily over here. So examiner answer, I will analyze in front of you, and this is the examiner answer. So first of all, analytical procedures, how to write, calculate the average receivable days. For this year, compare it to the last year and investigate any difference. One procedure, very easy. Review age receivable ledger to identify slow moving and old balancing. Status, discuss status with the company to assess likelihood of payment. Then review board minutes of the meeting. Any concern about payment by the customer? This is about existence. This procedure is about existence. Review post year-end cash received and follow through the pre and residual balances. This is again fourth procedure on valuation. Discuss with the finance director the reason for decrease in allowance and evaluate the assessment of the response. Recalculate allowance for receivable. It is accurate. This is vouching. This is vouching. No, sorry. Just this is cut off. Sorry, cut off. Affecting the yes. Again, accuracy. Now, the point is, select a sample of good dispatchment before and just after the year end. So, evaluation. Correspondence with the customer, any disputed balances. Now you see, this is vouching. vouching. I can send you this document as well if you want this answer. Okay, so only six to be written. Only six. Procedure should have, each procedure should have, sorry, it is not being shown to you. It was being shown to you when I was analyzing it. Tell me the answer. It was being shown to you. I'm sorry. I think it was not. I'm sorry. Once again, come here. Once again, I will analyze. Don't you worry. I'm sorry. I felt like that it is not being shown. Okay, once again. You see here, tech. This is called tech-related problems. Okay. So you see here, this is analytical procedure. Compare for valuation. Age receivable, balances review, allowance for receivables. Board minutes of the meeting for significant concern. The payment will not be received. Again, valuation. Post year end cash received. This is actually existence assertion. Existence assertion. Again, why it is decreased? Allowance for receivable. And what is the response? It is valid or not? Valuation. Recalculate the amount of allowance. Recalculate the amount of allowance. It is in front of you. Now, post year end. Now, yes. So just see here. This is cut off. Review of pre year end and post year end GDN. It has been recorded. Again, this is for valuation here. Correspondence with the customer. For what purpose? Any disputed balances and bad debts and provision for doubtful debts. Now, so year end balances. This is vouching. That balances to sales, GDN to record, accounts to record. Now it is done. I hope it is clear. Now each amount, each thing has, each procedure has, you have seen, each procedure has criteria. Pick. There is an action, you see here. Any procedure pick. There is a source. There is a purpose. These three must be there. And ideally, it should be scenario specific as well. The last S. Next, the next point is the next question. Come to the next question on the same. On the revaluation of land and building, one thing, and the recently purchased warehouse. I feel like this is the second past paper since yesterday we are doing. The procedures, substantive test examiner is not giving tough time. I don't know why I am feeling like in these two past papers. May it be like that. Because procedures are straightforward now, which are being tested, substantive tests. 5 marks, 5 procedure on these angle, revaluation. And recently, okay, Walker has policy of revaluing land and building. And this is undertaken on a rolling basis over a 5-year period. During the year, Walker requested an external valuer to revalue a number of properties, including a warehouse purchased. Okay, right. in September. Definitely charged on a pro rata basis. Now, the point is 5 marks means 5 procedures. Yes. Just a minute. I'm going to share my screen with you people. Now, so students, now revaluation of land and building. They have asked. So they have valued by externally valued work. So what should be the audit substantive tests? So procedure on revaluation. Okay, first of all, student, the rule is all the assets of same class should be revalued. First of all, auditor need to verify procedure on whether all assets of, of land and building category that has been revalued, procedure will be written on it. Now, then just a minute. Yes. Right. Obtained. So who has done revaluation? Who has done revaluation? An external revaluer. Valuer. So auditor will obtain the valuer report, assess the method and assumption used. Simple is that. Second, recalculate the revaluation as a adjustment. Revaluation adjustment. And verify it is correctly recorded in the revaluation reserve. Calculate, verify. It is correctly recorded in the revaluation reserve account. So 3 procedure I have told you. Total 5 have to be written. The remaining part of the question is on recently purchased. So at least 2 procedures on the recently purchased warehouse as well. Now, so verify. So the newly purchased asset on in September 20x4 during the year. So what auditor will do? Verify the cost of asset purchased warehouse, whatever is the name, warehouse, better right, fair house. What is the source? From? Tell me. Purchase documentation. And bank statement, if it is paid already. Yes. No, they have purchased. So review the title deed should be in the name of the company. Review title deed. Registration. Documents. Who is the owner? To verify. Ownership. is in the name of Walker Company. Very important. And yes, one procedure for everything. Because, okay, yes, this was purchased in September. Year end is 31st May. How many months? 5 and 9 months. So recalculate depreciation charge for new warehouse for 9 months and verify it is recorded correctly in financial statements. Very easy. How many procedures I have told you? So many. 6, 7. Still there is one. Financial statement disclosures. But I told you yesterday how to write it. You can write it here as well. Next. So 5 marks, 5 questions done. Now, director's remuneration. Director's remuneration, the procedures on that, 4 marks. Now, what should be the procedures? Okay, read it. Let us find something over here. Workers board is comprised of 6 directors. The overall remuneration has 2 elements: monthly salary and bonus. All remuneration paid, including the wages and salaries. Law required disclosure of overall remuneration analyzed by element by director. Okay, first of all. So they said right procedure, remuneration disclosed in financial statements. So first of all, we will ask management. What we will do? Obtain a schedule of remuneration will split into salary and bonuses paid and review it for arithmetical accuracy. Obtain. This is, you see, procedure. This is action. Why I am writing procedure like this? By breaking down. This is called action. This is source details. This is the purpose, source explained, and this is action. Okay, in this way, that's why I'm writing procedures separating like that. I have written answers, just like I did for the part 1, but I'm writing afterwards just to explain it better to you people. Second, they say monthly salary and bonuses. First of all, verify salary recorded in the wages and salaries and what is being paid in the bank statement. So review bank statement. Identify monthly salary to identify and bonus being paid to a director and verify it is correctly recorded in wages and salaries. Now you see here, we are comparing two sources. Two sources are being compared. From the bank statement, details what we need, action. This is purpose. And these are the sources and explained. Next. To students, yes, very important. There might be additional bonuses approved. Review board minutes. For what purpose? For any additional bonuses approved for directors. And what else? Ask a director. Inquire. You can write inquire. The bonus and salary they receive, and verify the same has been recorded in wages and salaries. Very important. And financial statement disclosure, you already know the procedures on financial statement disclosure. I'm not going to explain that again. Four only to be written. Only four. And it is not rocket science, only practice makes you perfect. Again and again. The next part is on audit report. 5 marks. In my opinion, majority students, they may lose these marks. Just read it. Then I'll be discussing it. You have reviewed the disclosure in the financial statement. Director, the remuneration is shown as overall total and not analyzed by elements or directors. So proper disclosures which are required by law, analyzed by element and by director, not given. The finance sector has confirmed that directors are not willing to adjust the finance statements. Okay. So first of all, we will discuss the issue. Remember the issue? The issue is that I discussed it with you yesterday. So first of all, the thing to be done is you will write the issue and you will narrate the disclosure that is required by law to disclose it by director and by element. It has not been followed by the Walker company. Next, May and June. A question is there by a student. Payroll means you are which record? You are already checking the payroll record? No. Payroll record and payroll. What is the difference? I didn't get the difference. Review the payroll record in May and June. I didn't get. And it is you are trying to compare two things. No, no, you are not trying. Your question is not clear actually. You are trying to verify, compare two sources. You have written it. You see here. So will it be wrong to review the payroll record in May and June? What is the difference between the two? I don't know. Perhaps you want to see, say, the a post year and bank statement. Perhaps, perhaps you were wanted to bank statement. Then what is actually paid to them, whether it was in the payroll record, the same amounts have been decided. Is it? Am I right? You want to say like this? No, directors are real. Yeah, this is, I think, that will be okay. Next, welcome. So the next point is okay. The final. So the first point I told you issue. So first you will explain the issue. Local law. So what is the issue? So law has been breached. So issue you will tell law require this. They have not disclosed in this way. So it is non-compliance with the law. So which is material misstatement by nature. If they do not resolve it, auditor will modify audit opinion. Audit opinion will be modified. The matter is not pervasive. This non-disclosure, you have to tell, is material but not pervasive. So qualified opinion will be given. And then you will explain what is qualified opinion, a bit, one line, and then basis for qualified opinion will include, what will include? Explain that the omitted disclosure, that's it. Sorry. Sorry. Here it is. I hope it is now. I'm sorry. So this is in front of you. Once again, issue is non-compliance with laws and regulation. You will explain the whole issue and then it is non-compliance. It is material misstatement by nature. Audit opinion will be modified if management does not fix it. So this non-disclosure of remuneration split, it is material by nature. It is material by nature. Now, the next is if it is not pervasive, so qualified opinion will be given, except for this matter financial statement give true and fair view. And a basis for qualified opinion will be followed, which will tell the reason for modification of opinion that there are disclosures which have been omitted. Any confusion, any problem? Now, the next part of the question is we've had to do talk about audit risk. Sorry, that is yes, 17 perhaps. Yes. 8 audit risk and audit response. Okay, 8 audit risk and audit response. So students, let us read it. It is 1st July 20x5. You are an audit supervisor at Elm and Company and you're planning the audit for the year ending 31st July 20x5. Oak Furniture is a new audit client, first audit risk. How to discuss this audit risk? So we know that audit risk is like this. So how you will explain it? It is a new audit client. The company, company name you will mention. So they will not be having audit firm will not be having their detailed understanding of their accounting issues, matters, policies, transactions. So may not be able to plan and perform audit properly due to this detection risk. Now, what is the response? This is overall audit risk. The response is that assigned experienced team for this audit who should obtain detailed understanding of the system. You should have detailed time to understand its business, its system, and then plan and perform the audit. Next, the next point is it manufactures office furniture, such as desks and chairs that will have other storage solutions. The end partner has a meeting with O company's finance director and have provided with the following notes. Oak's trading results have been stronger this year. The company is forecasting revenue of 85 million with an increase from the previous year. As a result of increase in revenue, Oak has recruited a new credit controller to chase outstanding receivables. The finance sector has informed you that although an allowance for credit losses has been historically been maintained, it is anticipated that this can be significantly reduced. So they are going to reduce allowance for credit losses, allowance for receivables. In other words, so what is the risk? The finance director They may have reduced the allowance for receivables, and receivable may not be recoverable. And hence, allowance for receivable may be understated. How to write? What should be the essential ingredients? First of all, issue. Finance Director said that allowance for receivables reduced significantly. The point is that it may be the reduced allowance may not be sufficient, not covering irrecoverable receivables. That's the possibility. That's the possibility. That may not be covering that. And hence, allowance now impact IRI. Remember yesterday? IRI. Allowance for receivables may be and bad debts. Sorry, may be understated and receivables overstated. In this way, you need to write. The company has invested significantly in the woodworking and upholstery production lines at factory. During the year, it purchased and installed a new manufacturing line. All costs incurred in the purchase and installation of assets have been included within property, plant, equipment. It include purchase price, 5-year servicing cost, 0.5 million. Really? This is blunder. Now, this is incorrect treatment. Remember, I told you yesterday, there might be some treatment which may be incorrect. So, first of all, you will write issue here. You have not to give heading of IRI. I'm just analyzing it. That they have purchased new machinery and contract as well. Maintenance contract, 0.5 million. They are capitalized all. Now, what is wrong? As per IS 16, maintenance cost cannot be capitalized. Maintenance cost can't be part of cost of asset. Service agreement. It can be capitalized separately. And if it is for 5 years, it should be expensed over 5 years. You have to write it. It can be capitalized separately and expensed over 5 years. So here, therefore, what happened? Property, plant, equipments are overstated here. Impact. What is the response? What is the audit response to this point? The response is that auditor will discuss this incorrect treatment of servicing cost with management and to request to record an adjustment. Previous point, I missed the procedure, the response allows for receivables. So simple is that. Discuss, because finance sector has reduced. Discuss with finance director the reason for reducing allowance for receivables and assess validity of their response. Simple is that. Next point. In number, Oak spent 400,000 advertising campaign. It has been included in intangible assets, amortized over 24 months. Incorrect treatment once again. IS 38 says advertising costs cannot be capitalized as intangible asset. Again, incorrect treatment. Similar to the above. Similar to property, plant, equipment. Incorrect treatment. So this advertising cost cannot be capitalized. First of all, issue, the company has capitalized in amortizing over 24 months. The amount of 400,000. As per IS 38, advertising cost cannot be capitalized. It must be expensed. Hence, if the management does not correct it, intangible assets and profits are overstated. Expenses are understated. Same. Talk to the management. Discuss with them the incorrect treatment of 400,000 to adjust it and record it as expense. Simple. Very easy. Double A is very easy paper. If followed logically. Yes. I'm just thinking today that if I should make some more video on the OTQs, some past papers, maybe in 2-3 days. I'm just thinking. Next. On 29th July, the finance sector announced that one of its huge furniture line was being discontinued due to fall in demand. This resulted in 4 staff being redundant. The department calculated the level of termination cost of redundancy and they will be paid in the August. So if they have been redundant during the year, in the July, so a provision for should be recorded as by 37. There is a present obligation. A provision should be recorded. So if the risk is that they may not have recognized provision. And liabilities and payables will be understated and profits overstated. Now, so first of all, the same you will write here. So issue, risk, and impact. Issue is that redundancy payments. Company is going to make redundant. Risk is that redundancy should be recorded, may not have recorded it. It is present obligation. Impact on 2 things. What is the response? First of all, review the post-year end. Bank statement. For what purpose? To identify actual redundancy payment made and verify the same has been recorded in year-end financial statements as a liability. Yes. Next. In June 20X5, O company decided what to revalue. Similar point where it was. Okay, sorry, that was in the substantive test, which has previously accounted for under a cost model. Properties with carrying amount of 3.8 million were revalued. Valuation performed by management. First of all, revaluation. Huge amount increase. They can revalue if there are. IF 16 allows that. The risk is that revaluation, it is done by the management, maybe on inappropriate adjustments, inappropriate assumptions. And revaluation and a property plant equipment may be overstated. Simple is that. Very easy to discuss it. So revaluation assumption you need to check, method you need to check. Being auditor, other response, whether method and assumptions are appropriate or not. Simple is that. Now, the next point is the finance sector also carried out an extensive non-current, decided to extend the useful life from 5 to 8 years. What will happen because of it? Depreciation charge will be reduced. Okay. So, yes, issue is that they have extended the life. IAS 16 allows that if assets are living longer, they can revise the lives. But the risk is that they may have done it to reduce depreciation charge only and to boost profits. And hence, depreciation charge may be understated and profits overstated. So, first of again, once again, so discuss with the finance sector the assumptions on which basis they have revised the life to 8 years and assess the validity of their response. Is it difficult? I'm loving it. It is very easy. Okay, students? Now, a member of finance team was discussed by O company in May 20X5, and it was discovered that they have been fraudulently purchasing non-current assets for personal use. Similar point we discussed yesterday. There might be some other frauds may not have been discovered. Other assets may be overstated. So control risk is increased. So first of all, what is the response? Auditor should discuss with the management the fraud and increase substantive tests on the non-current assets to verify there might be other similar fraud. Okay? There might be. Increase testing. Whether assets have been purchased for the business purposes only. No. The next is they started to investigate the fraud. Okay. The finance sector stated that there is a problem in June in the mixing of adhesive in the assembly process. It resulted in a large batch of chairs having defective bonding. Number of units have been shipped. Customer complaints about stability. Okay, valuation of damaged inventory. No adjustment have been made. Very easy. Issue, large batch of chairs, damaged, still had a LDAT cost. As per IS2, it should be revised, recorded at lower of cost NRV. So the risk is that they have not done any revision and inventory may be overstated. What is the response? Detailed substantive tests on NRV and cost of the chair should be performed to assess inventory needs to be written down or not. In the previous year, very important point, very important point. The management of Oak is due to be paid a significant bonus based on year-end total assets. Now, this is biased, risk of bias. So management may be under pressure to, and they may be biased to overstate assets of the company, total assets, to secure their bonuses. And hence assets may be overstated. So now, so what should be done? It is overall risk. This is overall risk. So overall response, increase skepticism, increase audit testing, especially judgmental areas, which are effective to increase the total assets. During audit, that should be done. Any question from your side? Any question from anyone? All right. So thank you for joining. I will see if I can arrange some more recording of one video, 1 hour on OTQs from past papers. More. Okay. That will be helpful for you to be done in the last 1 week. Okay. Yes, you are welcome. I hope you enjoyed the class. Okay. I will be sharing its video today with you as well. It's today. Okay. So you can rewatch, share with your friends who need it as well. Okay. God bless you. See you. Take care. Goodbye. Goodbye.